It was a noisy week in U.S. markets with record money inflows, and that worked its way into a buying panic ahead of the long weekend. But while Wall Street ended at record highs, the sentiment on Main Street has collapsed. The frenzy of trading in U.S. equities is not slowing down and looks to surpass levels that were seen during the worst of the pandemic panic in March. And it's not only the pajama traders with their stymie checks. Over the last 15 days, an average 16.2 billion shares have traded each day on all U.S. exchanges. And if you're as old as I am, you can remember when it was less than a billion shares in a month. The 16.2 billion shares is just below the 16.8 billion average hit on March 25th, which was the highest in over a decade. And these bursts of trading volume often come during periods of surging volatility. To me, this looks like another sign of a stock market exuberance. But I'm loving the fact that energy stocks are the week's best performer. Bitcoin also screamed higher, breaking above 49,000 at its peak after Elon Musk said Tesla was a buyer. Do you think Elon will buy oil? Well, maybe not. So while everyone is distracted from the DC sideshow, you and I will look at what's really important. So let's go. First up, Bank of America has come out with a warning that the market exuberance may precede a correction. This is indicated by the amount of stock fund inflows, which were $58 billion in the week through February 10th. At that same time, Bank of America's gauge of market sentiment, the so-called bull and bear indicator, is approaching levels of extreme bullishness, which can trigger a sell signal and hasn't been set off since January of 2018. On the other hand, stimulus measures across the world, along with low bond yields and optimism that vaccination measures can lead to a reopening of major economies, can continue the bullishness. Two more things to pay attention to, beginning here with the CBOE 10-year U.S. Treasury Index, and the symbol is $TNX. Again, this is the 10-year Treasury. And as you can see here from this bottom in August, we've continued to climb up all the way here. Now, the measure says 12, but it really means 1.2%. I don't know why they do 12. They could just put the period here and it would be correct. 1.2%. So keep watching that. Back here at the beginning or end of 2019, beginning of 2020, the level was near 2.02%. If we get up to that level, that might start causing some pain. If we get up to 3%, that really is going to cause pain. But watch this as it moves up. Now, if you go down here into the Mac in the lower portion of the screen, you can see this move up with the fast line and the slow line. They're moving together. Well, that, my friends, is manipulation. You see how regular and methodical that move is all the way on up? That is manipulation. Go up here to the RSI. You can see the bottom there in that March time frame, and it's continually risen all the way up to here. Now we're at a 68.08 level, but we still have more to go, perhaps. So watch that, because once the yield rises, that's going to cause pain, and that could cause a correction in the stock market. Okay, let's go to our last measure. And now we're looking at the 2-year weekly chart on the US dollar. And both the 10-year Treasury and the US dollar, I'm using stockcharts.com. For the dollar, the symbol is $USD. And here, what's important is if you go down to the lower portion of the screen, you can see the MAC. We bottomed here. We attempted to move up. We did move up through that slow line, but the fast line came back down again for a second dip, and now it's going to try another move on up. It's crossed through that slow line, and it would like to head on up. That might be a double bottom, at least in the MAC. It doesn't necessarily show as a double bottom here in the price chart, but I think you get the idea that things are strengthening. Now, similar to the 10-year yield, if the dollar rises, that could cause problems as well. The dollar has been inversely correlated with the stock market. So if the dollar goes up, the stock market comes down, and it's trying to bottom and base and gain some strength for a move on up. It's still pretty weak, but when you take a look at other longer term charts, which I don't have the opportunity to show you, you can see that the dollar is definitely strengthening. So keep your eye on this. Again, you can look at stockcharts.com for both the US dollar and the 10-year treasury. And so to wrap up this week, these are 3 signs that you need to pay attention to that others aren't telling you about. So keep your eye on these. It's easy enough to take a look at these charts and watch the movement, because inverse for the dollar, and as interest rates head up, that's going to put pressure on the stock market. And for today, that's ChewDog Charts. Thank you.